Buddy. Hello. Happy Thursday out there, everybody. Good morning. Welcome to the Daily Profit Plan. How is everybody doing? All right. I'll grab the screen here on Zoom. We're live on YouTube. Let's go. So share the screen. Chat is up and running. And chat should be open for everybody as well. Okay. Well. All it took was 3 weeks to get back to all-time highs. So what was the point of trading this entire year? Funny stat, this is what was said last year during Liberation Day. Clients that forgot their passwords or died did the best last year for most retail accounts. Maybe the same thing should have happened this year. Just kidding. No, the market's up like 2%. We should be up more than that because we did trade through this whole environment. We've navigated this whole environment. I would say daily profit play grinded our little butts off for the first 3+ months of trading. Waterfall income. This is why we avoided the weakness window. Did we not? And we're seeing the benefits of it now. We've all of our expirations for April looking extremely good for profit. Same thing with May. A lot of those trades are sitting at like 97, 98, 99% chance of profit with current markets. VIX still at 18. And also, I mean, the market would have to drop 10, 12, 15% from here. Not saying that it can't happen, but it's highly unlikely given the quick turnaround we've seen in the last few weeks. Markets certainly seem to click on the faucet for risk appetite and risk on. Leslie explained the unusual trades behind 3 high-risk trades that scared me. I don't know what trades you're talking about. I mean, daily profit play was a standard daily profit play. We took butterfly spreads, closed out within a couple hours for like $300. Those are low risk trades, actually. I mean, I was risking $500 to $600 to make $2,000. And once I looked across the board and saw that I was up about $350, I just closed the profit. So I just put I kind of blanketed out there with those profit traps yesterday, if that's what you're referring to. And then the one trade we took in we had this trade set up in the morning, it got filled in the afternoon. 70.30 was our top side and 6,900 was our bottom side. We got filled for $1, closed it for easy dollar. Price tested it though. It was close. Yesterday's high was around 26. So, we had our expected move box with gap adjusted calculated at 70.16. We put in the 70.30. We also saw a gamma level at 70.25. All these things are a part of, how I picked my levels, and it worked out in our favor. So it was a pretty easy. I put in a couple contracts, so a few $100 yesterday. Yep, good stuff, Dave. Love that. Is there sound? There should be. I think I'm talking to everybody. Chat's open for everyone on YouTube as well. So Eric's here, Don is here, JJ, what's happening? Catherine, Matthew in the house, Randy, Walter, Greg, Dave. All right, good stuff. Audio good. All right, hey Brandon, hey Mark, TJ in the house from YouTube. All right, so a couple things. Let me log back into Tasty. My dog's a little frisky this morning. He got a nice ear clean this morning. You're disgusting. Come here. Come on. I'm trying not to get everyone in the household sick. Just got hit with one of those awesome little like spring, summer colds. So give me a sec. This week I'm keeping what's the tea company? Celestial something. Keeping them in business, and Ricola cough drops in business. All right, so we're logged in. I'm guessing that the expected move is in the 30s. 35.13. We've been dealing with this all week. 35.13. Okay, we're going to have a slight gap adjusted move again. Tomorrow is an OPEX, so options expiration, with one on Friday. Going up into this, seeing the volatility index get crushed the way that it has these last couple of weeks from a 31 VIX down to 18 VIX. It wouldn't surprise me if there's a little bit of risk coming back in the market. I've said this all week. I mean, we're on a pretty impressive run. We haven't had this many days in a row close bullish since like 2021. That's post COVID, like crazy melt ups. Even last year, when Liberation Day pivoted from, hey, we're going to tax the entire world to we're going to trade more with the entire world. The market loved that, but it still didn't move this direction this quickly. So, again, I talked about this yesterday, thinking like, okay, we're starting to run out of steam. This is not to call the top. This is talking about the kind of the standard practices we do every day in daily profit play. The strategy is I'm looking to sell premium every single morning, trying to stay out of the way for highs and lows. Okay. Don't be a hindsight trader and say, Chris, the market's been so bullish, we should just buy debit spreads or do bull push. I fucking get it. I get it. I wish I just did one sided trades all week. Okay. But we've done fine. Like I got over my like I said, over my skis on was it Tuesday? Because we had the market on, so even yesterday we exceeded the move by just a little bit. I stayed out of the way with that 70-30. Um was it this one? Yeah, it was this day. So I got a little cocky on Wednesday. No, sorry, Tuesday. So this is Wednesday, this is Tuesday, this is Monday. I got a little cocky on Tuesday, and this is my fault, but I take responsibility for my trades. Um, is we were outside the expected move box Monday. I got a little cocky, trying to call the top and the bottom on Wednesday. I'm sorry, Tuesday, and I was off by I needed 5 points. Literally, the close was 5 points off for me having money in my pocket versus me not making any money. I ended up losing about $1,200 on Tuesday. Yesterday, between a futures play and the daily profit play and those butterfly spreads, ended up making, I don't know, like $600 yesterday. So I mean, chipped away at the loss from Tuesday. It's just part of the game. But what's interesting is this beat the expected move. This beat the expected move. This beat the expected move. Very rarely do we see this. Okay. And on top of that, not only did it beat the expected move, but it closed at the highs all 3 days. If you've been trading with me long enough in daily profit play, if you've been trading long enough in zero DTE, you know that rarely do you see the market open, close at the exact high of the day, or open, close at the exact low of the day. There's usually some type of balance in the market. Market makers are at least somewhere. And the fact that they've like pushed this and this has just been full tilt, all systems go, buy, 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 buy. Um, it's rare. That's all. So this morning we look at this setup and we have gamma a little bit closer together. Yes, there's some wide open gamma here towards 70-70, which okay, fine if we're going to have a big run to the upside. But notice how my positive negative gamma pivot is much closer, 70-15, right? We have all-time highs back at 7,000. Is it possible that after 10 out of 11 days in the S&P to the upside, we can see a pause? Very possible. Is it possible in the Nasdaq, 11 straight days of bullishness and higher highs and higher lows and higher closes that we can see a pause? Sure. So let's see what happens, right? So we're looking at a plus or minus 35 in the morning. We'll have a slight gap higher. To be safe, I'm probably looking at sprinkling in some call spreads up towards this level, but it's going to be a low delta again. I wouldn't be terribly surprised to see the market, hitting 70-30 or 35 and then falling back down towards positive negative gamma pivot on the day. Does it fall all the way out? I have no idea. I have no idea. We can find out. But these are right now like low end gamma levels. I mean, the biggest resistance is going to be around 70-30 and see if that actually holds. The JP Morgan collar trade, yes, it was out to the quarter, which would end June 30th, and it's already at the 7,000 handle. Now, either this level is going to be defended fiercely and we see the market reject this 7,000 handle, or everything has been hedged into it. And what was a collar trade, and this would be when we were talking about this back around like 6,500, 6,600, prices around 66, 7,000 collar trade to kick off April 1st. We have a 7,000 resistance zone for the JP Morgan collar trade and 6,000 support, right? We're already at 7,000. We did this 2 weeks, right? 2 to 3 weeks of trading. We're all the way up here. That's crazy. Now, this as a ceiling could certainly become the new floor. So if we breach this and keep going, coming back to it would not be a surprise. But if we reject off of it, okay, it's still going to be something that the market's probably, putting flows around and hedges around, and it will become a significant round number at some point. Whether it's the ceiling or it's going to become a future floor, remains to be seen. But we'll have to find out, right? But the amount of call volume is nuts. In fact, I think I saw this yesterday. Let me check here. I took a screenshot of it. Oh, I've got the ticker here too. If you go, no, it's put call ratio. I added to my workspace. I can't remember the ticker. CPC. So this is total put to call ratio. Put this on a line graph, and you will see that this is the lowest put to call ratio we've seen in 15 years. I even looked back. I was really interested in this. So all the way back here, let's go to a weekly time frame. That's weird. Literally looking at this yesterday, this is all the way down here towards this green line. Somehow that changed on me last night. That's strange. But I was looking to see, okay, where are some of the lowest levels where it's put to call? So much call volume. I mean, I looked at some of these turning points. This is 2007, before the market started to roll over. This is 2009, after the market had bottomed, right? This is 2011. I mean, from post 2009, market was in an uptrend and stayed in an uptrend until 2020, essentially. We had a couple choppy sideways moves, some volatility events and whatnot, but for the most part, it was higher highs and higher lows since the bottom of 2009. So this last night when I looked at it was all the way down here towards this green line, and that's where I was like, yeah, lowest in 15 years. So I don't know if that just changed overnight. Maybe there was some trades that went off the table if it was like open interest stuff, but doesn't matter. Anyway, it's been a frenzy, and it should make everyone feel better where we are, as far as, hey, we're back to all-time highs. I mean, it shouldn't be a bad thing. So I mean, what is frustrating is if you trade every single day and you lost to the upside like I did on Tuesday. That wasn't fun, because in hindsight it's like, oh well, this should have been super obvious. I mean, look, I've said this this is now going on 2 years. We have seen some pretty impressive days to the upside that beats and exceeds what I calculate, which is rare. When you can take a VIX move and you can take an expected move and you can take this box and all these math things calculating the options market and still see price go higher than it really should. I mean, it is what it is. Like, I have to accept that. If I'm trying to call the top and I'm getting in front of a steamroller of a bull market for the day, 0DT is exactly that. Like, you have to just manage risk and survive the day. That's it. So anyway, let's go ahead and update this. We're at 35.13. So 35.13. So as far as the momentum to the upside as well, we've seen, intraday, we really had a huge gap. I mean, you think about how did we get to all-time highs in 3 weeks? Well, most of it was the ceasefire gap, right? This was all pushed over the weekend. Okay. This like Tuesday, actually, this is an overnight gap. So this is a Tuesday to Wednesday when the ceasefire was announced. And that gap, this was the, Tuesday to Wednesday announcement. Market absolutely loved it, ripped in futures that overnight session. But intraday, I mean, this was probably our biggest move of the last couple of weeks. Right here, the market moved about 80 points, then about 50 points. Yesterday was about 40 points. So, I mean, again, we could have another big day to the upside today, maybe. But I'd like to think that after all these significant higher closes, that the market's just going to stall a little bit. Okay. I also talked about this broadening pattern in case this means anything. Maybe it does, maybe it doesn't. But we have resistance. We have resistance. Could this be hitting resistance around this like 70.50 to 70.75 zone? Maybe. And the last time we've seen this many consecutive closes higher, this is 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 10 of 11 on S&P. 10 days out of 11 days, straight up, higher closes. Go to the Nasdaq. More ridiculous. This one hasn't had a lower close in 11 sessions. 1, 2, 3, 4, 5. Even though this is red, 6, it closed higher. 7 closed higher. 8 closed higher. 9, 10, 11. 11 in a row. Wild stuff. Okay, impressive. But again, it's like, what was this? Unnecessary is really what it was. It was noise. Okay. So the market just wanted clarity. This is what the market's probably best at, is making, both sides uncomfortable. I mean, think about how many people were loaded up ready to be bearish. Now look at them. Peter says, you ever look at doing 1.5 times a market maker move? I mean, you're going to get zero premium for that. If you went 1.5 times a market maker move, you get filled on occasion. You've got, the probabilities go up, but I wouldn't take a trade. Just if you if you went 1.5 times and try to put the trade in the morning, you're going to get garbage premium. Your deltas are going to be single digits every single time. Every single expected move, if you go to the expected move, you're going to look at about a 20 delta. 20 to 25 delta is going to be the expected move. You want to go 1.5 times that in a 0 DT environment, you're probably talking 10 delta, 7 delta, 6 delta, 5 delta every single day. Okay. It still isn't safe. So if you see the credit, it's going to be garbage. It's going to be terrible credit, very low credit. You get filled on occasion, and maybe the market gives you the same type of, well, it was a 5 delta when I got filled this morning, so I should have a 95% chance profit. You probably do. The only issue is you're going to get filled like a third of the time, a quarter of the time. You're just not going to get very many trades. Okay. This is why I take defense trades. If I'm going to put trades in, I'm going to try to play some defense. I accept what happens. 0 DTE is lots of reps, hundreds and hundreds of trades a year. Okay. If I lose one, okay, learn from it, take accountability for it. I put the trade in. I went too wide. I put too much risk on there. That's me, but I accept it. If I'm trying to go further out and safer and 2 times, expected moves, it's like you're just not going to see the market fill those trades very often. Markets are efficient. Yes, it's not been efficient these last couple of days. It's been very rare to see, like I just said, 3 consecutive days outside my gap adjusted expected move box and closing at the highs all 3 days. That's insane. In a 0-day environment, it just shows like there's zero resistance. And there's been little to no pressure in this market to even go down. So it's just like the market just needed permission to go. And it's been all systems go for 3 weeks. So again, continue to grind. If you don't like the idea of getting in the markets every single day, then don't. Trade waterfall income, right? Where we have stacked up results and we're going to see a windfall for the next 60 days of profits. Because we avoided the weakness window, we played through this drawdown the market had. We didn't take a single loss, and we're going to have a bunch of profits here in the next 10 days, 20 days, 30 days, 45, 60 days. We stacked up trades all year. Okay. If you don't like that, trade engineering options. We do stuff every single week and month. Got another winner this week. Markets, I don't even know how many points clear, 20, 30 points clear of our prices. So there's ways to get around it, but I don't mind stepping in the markets, and it's exciting. Not why I trade. I trade to make money. Daily profit play is a good system. It works, but you do have to manage risk, and you got to be willing to step in and bounce back if you lose. Okay. Don't be scared. There are good trades ahead. Okay. I mean, I took 1 loss this week. Okay, fine. I've already clawed like half the losses back in a couple of days. It's fine. But it's better than taking, 20 days, 30 days. It's not that big of a reset. Just keep trading. Okay. I mean, that means they're still good, Andy. If there's still expirations on those pinch point trades, they're still pending orders, they're still good. I'm just gonna let them go. Okay. Let's see here. We had a couple of pinch points close for profit yesterday. IWM close for profit. That was a nice winner. That was like 80% winner. And what was the other one? I think let me go to this Telegram here. We're opening up in about 8 minutes. Also got a couple nice trades this week on Project Options Edge. Took a trade yesterday on Tesla. Took a trade yesterday on Broadcom, AVGO. New trade on NVIDIA yesterday on Project Options Edge. Nice trade on the SPY this week on Project Options Edge. Pinch point winner on IWM. That was an 80% return. Took the winner on INTC Intel for about a 60 or no, an 85, 86% return, 83% return, something like that. New trades. Yeah. So we've got all those trades posted in. They're still pending. I'm gonna let them run. Just let them run with the setups, the technicals, the dashboard. We went from like 27 stocks and pinch point down to 17, so things are already starting to move. If I don't get filled, I don't get filled. It's fine. I use the pinch point scanner to find good stocks ready to move, and then I try to find good key technical levels and prices that make sense, where we can get a 1-to-1 or better, and we can play the higher probability direction. Which right now I think the higher probability direction on almost everything is being bullish. Okay. So a lot of those you're seeing as bull call spreads. If you're looking at my pinch point alerts, you're going to see a lot of debit spreads. And the reason why is I'm looking on the chart, trying to find if it gives us a dip. I'm just not assuming the market is going to go up. But if it is and it runs away, it's fine. Then they don't fill. No big deal. Okay. Double ups. I mean, yesterday I really should have posted those trades for double ups, but it was a lot. I threw in like 3 butterfly spreads in the morning. That should have been a double up alert, but I was, in the middle of daily profit play. So double ups, I'm just trying to follow some flows. We can look and see what lines up for, so I mean today's Thursday. So today and Friday with some of the big expirations we have. Take a look at SPY, Qs, XSP, SPX. Look at some of the tomorrow would be a 1 DTE going into Friday for all your Mag 7 stocks where you get those highly liquid movers, and see if we have some targets that are going to be hit. But I mean, we took a trade like 2 weeks ago and made like 500%. So double ups is doing fine. I just need to, find some decent flows. Yesterday, the butterfly spread that worked out really nicely was that, that we had 69.90 that paid out a couple $100. We had the 70.15 that actually would have been a pin price around $1,600 around that pin price, because we had the 2 gamma levels. If you remember my session yesterday, we had 2 gamma levels, one at 7,000 and one at 70.25. So I split the difference and I did a 70.15 pin price, and the day settled and closed at 70.22. So you're only 7 points off of that. You were 25 or 30 wide on that spread. It was a $6 butterfly. All that means is max profit about $25. Take down the 6 for the debit. That brings you at 19. You were off the perfect pin price at 70.15 by $7. So you're at like $1,600 for the trade. Like that's the net result. But you had to hold that all day to achieve that $1,600, and then you would have taken full losses on the other ones for $500 to $600. So it was better to work the trade through the day and see like the net profit as things were kind of overlapped in offering that $300 or $400 profit. Okay. Where's the daily profit play session yesterday? So I wasn't on Zoom yesterday. It would probably be popped up in my YouTube channel, youtube.com, Chris Pulver. So the team switched the schedule around this week, where we are not. I wasn't live all week on Zoom. I've been live all week on YouTube. So if you are on my YouTube channel, youtube.com/Chris Pulver, then you can see it there. All right. So we got opening bell in about 4 minutes. Let me update. So 35.13 on the expected move box for today. It's going to be gap adjusted. Futures up about 0.14%. I'll take a look at the deltas this morning. We'll get our real-time gamma up as well. I think just to be safe, it's like I might want to just sell the expected move box high. I acknowledge like this is maybe the plan is maybe going up here with a stack trade. I mean, if we open at 22, gap adjusted, and we're going to get to 70, I might put a bigger trade up here and see if price can find it. Okay. I don't think this is going to give us a ton of premium if we start, 45 to 50 points higher on a plus minus 35. Okay. Also, I do think after 10 to 11 higher closes in the markets that we're probably due for a pause or a pullback. And I don't know if today is going to be the pause day and tomorrow with OPEX is going to be the pullback. I really don't know. I don't really care either. I'm just trying to figure out, can I make a trade today that makes sense? Is it good, mathematically? And do I have a decent probability of profit? Okay. So when I see gamma this morning, 69.75, that's the lowest gamma. It seems like it's way out of the way. That'd be 50 to 60 points lower. But it's going to be a low delta. And if price is going to move at all for a Thursday, I mean, I kind of want to stay out of the way. I was looking for yesterday's trades in waterfall and others, just not seeing them. Well, what's to look at? I'm just saying the trades we've been taking every single week for the entire year are starting to show us that, hey, look, everything's looking great. I did eliminate a lot of risk when we had those like 63 and 6,400 strikes. Um, but if you had, 50 cents credit, 75 cents credit, a dollar credit on any of those waterfall trades, they're now offering, 80 to 85 or 90% of that max credit. So, I mean, the fact that we were in like 15 or 16 live trades stacked up, building inventory on waterfall income, you now have a nice little windfall of profits if you want to start protecting it. Okay. So again, you can hold it through expiration and you can start protecting profits. You can do whatever you want. I'm going to hold because the probability of profit remains very, very high. I don't think we're coming back to 6,000 in the next, 14 days. I don't think we're coming back in the next month and a half. I think by, April and May, I would like to think that the market is, putting this Iran stuff behind it, looking ahead to earnings. If earnings don't disappoint, I think the market's going to be climbing the wall of worry all over again, and we're going to try to just kind of grind through these all-time highs. It just seems like it's the the easier flows right now is like, hey, we did it. We got through this correction zone. Market's priced in for other stuff, right? There were a lot of tailwinds coming into 2026 that didn't really materialize because we were sitting and stumbling at all-time highs. Then we rolled over with all the geopolitical risks. Now that the geopolitical risks have been put on the side, U.S. and China. I mean, if you saw Trump's Truth Social thing yesterday or the day before, I mean, he's talking about how well we're working with China right now. It's like the fact that we're saying that we're working well with China is kind of interesting. Hopefully, it's true, but I think it would make sense that if you're world number one, world number two, you could probably do a lot of good for the world if you work together versus not. So anyway, we just opened up here around 70.40. That's live feed. So let's go SPX. I'm going to try to get some April 16th, 70.65. I'm going to try to sell some pretty tight delta right here. So 16. Let's see what this looks like. 55 cents credit, 80 cents credit. I'll slide these down a little bit. 95 cents going 5 wide. I will take my chances. Let me try this. I'm going to try to go 10 wide. I want to sprinkle in some defense if I can. That's 15 wide. So 10 wide for $2. Okay, I'm going to take my chances on this for $2 credit on bear call spreads. That's a pretty good fill. Plus minus 25 in the day. I'm taking my chances here. Oh, I'm getting in quickly. Hang on a sec. That was the wrong account. The fudge. Okay, let's do similar. Okay, I'm going to try to get a $1.80 and change for this. Got to be quick. I'm doing bear call spreads starting at 65. So $1. I'm going to try to take $1.70 right now. Come on. It's fading quickly. $1.65. Give it to me. All right, just got filled for $1.70. If you want to leave it for $2, that's fine. I'll post it in chat. The trade that just got filled, it's 70.65 and 70.75. Those are my bear call spread levels. I'm 10 wide on each. So it's coming in hot. You can let it marinate for a second. So new trade, SPX, 416 expiration. That is 65. And then 10 wide. 70, 70, and 70, 80. So $1.70 credit filled. And right now it's trading for about $1.75 to $1.80. So you can get a little bit more premium than I did. Delta wise right now, that's a pretty decent starting point. That's a 15 delta. If I want to play some defense on this, those are my sell levels. I can play some defense with a butterfly. See if I can go. Call side's going to be a little trickier, but 70, 70, that's 15 wide. I'm willing to pay maybe like 20 to 30 cents debit on this if I can get it, but it's going to be probably more expensive than I want it to be. Let's find out. So if I went, that's 15 wide right there by 20 wide. Okay, that's probably more in my ballpark of defense, paying 20 cents for a debit. This one's got less risk to it. If you want to take less risk, it's a 40-cent debit on a broken wing, $540 max risk. This one's a little bit cheaper, but I take on double the risk at $1,000. So I will hold off on that for right now. This one's not terrible. That brings me now to about $1.30 on the day, if I'm right. Okay, nice fill there, Catherine. $2, good. Yeah, that'd have been nice to grab that right away. So we'll see what happens. I'm just going to do the bear call spread for right now. On the put side, VIX is still 18. The only thing I'm really hesitant on the put side is if the VIX all of a sudden starts to go to 19 or 20. We're still trading with a very elevated VIX where all it takes is if the VIX calculation is 18, that still means the market can move like 1.15%. And that's going to be way beyond that plus or minus 35 that we're calculating from the expected move in the mornings. All right. So my expected move box is gap adjusted at 70.75. So I definitely want to have some defense up there. Is it cheaper to do this type of trade for $1,000? Or is it cheaper to do a 70.75 pin and maybe a 20 wide? That's probably more expensive. That's $2. 15 wide, that's $1.30. All right. Yeah, the broke wing's probably the cheapest. So if I do 60 by 70 by 85, 30-cent debit, keeps me defended. That would give me a break-even price around 70.80. Let's see here. See if we can get this a little bit cheaper. 35 to 40 cents isn't terrible. It just takes away from my credit. I'm going to put these same trades in. 65, 75, 70, and 80. Now it's trading for 2 and change credit. Let me go for something big like what's a $10 credit here? That's a 1-to-1. I'll try that. I'll try more like $15. This is wishful thinking, but I'd risk 500 to make 1,500 if this gets filled again. If we're threatening these levels, I'm going to go for a round 2 of these trades and take $15 credit out of them. Again, it's very difficult to fill that, but if it does, that's a pretty good defense trade where I'm getting $1,500 potential profit for risking $500. So this is going to be a pending order for defense. It's just like stacking in with more credit. And then I'm still going to defend my levels here. So 60 to 70 to 85. This could be a little bit cheaper. That's 35 cents. That's cheap there. 15 cents now. I'm still accepting the risk. That puts my break even at 80. My expected move box is 75. Let's see. I'm going to tighten this up. Let's see if I can get this for like 25 cents or lower. Let's do, I'll see if I can get a 30 to 35 cents is fine. Little defense if I need it. I don't want it, but I think it'd be helpful to have it. If price slowly goes up, this debit's just going to increase in cost. So if price falls, it's going to get cheaper. But I don't mind having the defense here for a little bit of a debit. Let me try to get that 30-cent debit. That's what the mid price is right now. 30 to 35 cents defense is fine. So I'm going to overlap the strikes. You just got to be mindful of this. If I'm going to take this trade, it's an overlap in defense. Right now, it's showing 30 to 35 cents. Let's see if we can get filled here for that overlap. All right, let's try 30 cents again. 30 cents defense. 35 cents defense. I don't want to pay more than that. Keep that marinating for a second. 71. Is this cheap enough on a 20 wide? That's pretty cheap right there, actually. Well, it was. Let's see what we have for price. A pause day would make a lot of sense. All right, I'm just going to chill on the defense for a moment. I'm looking at a butterfly spread here. Let's see. So one thing we've been watching all week is this. If markets open higher, pull back and fill the gap, and they start to grind all day, that's pretty much been the market's MO this entire week, right? They gap higher, little pullback, they rally, they pull back, they rally. They've been hitting highs and closing at the highs. My expected move box is 70.75 with a gap adjusted move. That opened up from here about 0.24% higher. So we'll see. I'm just going to hang in there. I'm just going to hold off on the defense right now. I'm taking my chances on the probability that a 10th and 11th day and 11th and 12th day is going to be very rare and hard to do for the market. So I'm just going to stick to the call side for right now and see if I can just pull as much out of this $1.70 as I can. So these are bear call spreads from this morning. So pulled in $1.70, and it's just around break even right now. If you got filled for 2 and change, that's a great fill. You're already starting to see some profit. Okay, you're in a defense at 35 cents. Okay, good. Rick says my broker won't accept the $1.70 credit. Current mid is 450 credit. That's not based on the trade that I have right now. This trade's trading for like 190. I mean, if you did the bear call spread combo, so it's 70.65, 10 wide, 70.70, 10 wide. That's showing about $1.80, $1.85, $1.90 right now. So 450, I don't know. That seems way off. If I put this back into the trade, I mean, I see the mid price at $1.85, $1.90. Now it's up to $2. I mean, you can get filled at a better price than I did if you want it. Okay, daily profit only showing 70 cents. Nope. Showing $1.90, $1.95, $2 right now for a bear call spread. If you're doing a standard daily profit play, let's go 10 delta. So if you went 10 delta and you went 10 delta, you're showing 65 cents for a 10 delta iron condor. That's the type of trade that I wouldn't take for 65 cents. That's the type of trade that I would put for $1 and let it sit. Like, if you want to be rigid on daily profit play, go to 10 deltas, set it for $1, take the trade. If you want to go 13 delta and a 12 delta, now you're getting 80 cents. You want to go 15 deltas, there's a 14 delta, here's a 16 delta, now you get 90 cents. I still wouldn't take that. Now it's over $1. So, I mean, between a 10 and 15 delta, I mean, what's the difference? Well, a 15 delta is going to give you a lot more credit. So you may get an extra 20, 30 cents credit for it, but your probability of profit is decreasing. A 15 delta is about an 80% chance of profit, mechanically speaking. A 10 delta is going to be about a 90% chance of profit. I mean, if you're going after the same risk returns, like return on risk at $1 credit for $4 risk, that's a 25% return on risk every single time these trades fill. I'd rather have that 25% return at a 90% chance of profit than an 85% chance of profit if I'm just going to be mechanical about it. Right? So anyway, just saying, pick your battles. I'm doing bear call spreads this morning. Look, I'm being a little stubborn. I'm not going to lie. I'm being stubborn that 10 days in a row, 11 days in a row of higher highs, I'm looking for a pause day. It's that simple. I'm looking for a pause. You know, the market doesn't have to go rip into the upside another 30, 40 points and break in the expected move box. That's all I'm really asking for. You know, it's not like I'm shorting the market right at the money at 70.40. It's like I'm going out to 65 or 70. I'm trying to use that expected move box. I'm trying to basically go out of the money to take my bear call spreads. I'm trying to use logic here. But anyway, I'm just going to hang out. So I don't have a defense trade in right now. If I put in defense, I might put in defense with a butterfly spread. Might be a little bit cheaper to do so. So my threat starts around 65. So if I did 85 by 65 by 05, that's 20 wide. So right now that's 20 wide for 80 cents. If this trades for, let's say, 30 or 40 cents debit, I don't mind throwing it in there to kind of, sacrifice from $1.70 down to $1.30, $1.40, but I have up to a $2,000 profit trap. So that wouldn't be terrible. But I'm going to hang out and just kind of see if that will take for a sec. If I went 20 wide here, that's where my real risk kicks in. That should lower my cost. So 50 cents debit on a 20 wide, now showing about $1 debit. These numbers are wild, man. Like bid to mid to ask is, it's over $1.60 wide in SPX. This is what I'm saying. Like, this is a weird market. VIX is at 18. Bid mid ask is still very, very wide for SPX, which should be within, 30 cents, not $2. But just going to let the day do its thing. Okay, let me catch them on some comments here. $1.80 on my trade. Okay, good. Nice, Roy. That's fine. Combo for $2. Okay, good. Defense for 30 cents. Good. Dave O says, I got 470. Dave, then type in your trade, man. There's no way you took the same trade I did to get $4.70. There's no way. So type in your strikes. What strike did you sell? What strike did you buy? Make sure you have today's expiration, not tomorrow's expiration. Just those little things make a big difference to the trade. Okay. Good point there, Mike. Mike says Mags is weak. That's an encouraging sign to see the market might drag a little bit lower today. Drazen says he's looking at the AM expiration. Not tomorrow, maybe tomorrow morning then. So are you looking at the April 17th AM or April 7th? It might be tomorrow's expiration. Just double check that. Yeah. All right. That is correct, Carla. Yes, I want the trade today to stay below 70.65. I want price today to stay below 70.65. Okay. Now let me see what I can get that defense trade on for. I don't mind throwing it in there. I'll feel a lot better to have it. That's 10 wide, 15 wide. That defense would cost me. I'm going to try to get a 30-cent debit here. That way it puts my break even around 80. Gloria says, I did the single bear call spread for $1.10. Okay, that's not bad. Not bad. Okay, let's see. That's 15 wide. Man, I'm right in between. Like that's a 10 wide profit trap. That's fine. I'd like this to be cheaper. I'd like this to be like 25 or 30 cents. Otherwise, I may try this. This is 20 wide, 20 wide. This is just a butterfly spread on the put side. But again, it's like, is it more expensive? I don't want it to be. So if I get filled for like 40 cents with a chance to make $2,000, I'd much rather have that trade if I need some defense. But I'm just going to go back and forth and kind of compare the two. Price is falling a little bit. This should get cheaper. If price falls on my option chain, if we go down to like 70.25, 70.20, then we should see this put spread, this butterfly spread get a little bit cheaper. This one might be a little bit cheaper as well. 40 cents, 25 cents, still 10 wide. I'm going to try to take this one for a little bit cheaper defense. 15-cent debit. Try 20. All right, I got filled for 20 cents defense, and I'm doing the broken wing butterfly. So I bought the 60, sold the 70, and then I bought the 90. So I am risking over $1,000 on that trade. Because of that small debit, my max risk is $1,000. My break-even price is going to be 70.80. Okay, which I'm obviously hoping that's safe at a 7 delta, not be at risk. If we're going to threaten the expected move box high in the 70s, hopefully that's enough of a profit trap to offset some of the risk. And obviously for the day, I'd like to see price not go up to 70.60. or not go up to 70.65. I'd like to see price just stay maybe pinned around 7,000 today. Okay. So I'm going to keep an eye on this. I'm just going to add this in to, this would be like top defense. I overlap my strikes, but I'll show you what I'm going to get at here. So top D for defense. So between this total and this total, if I'm watching here, let me use a different color here. If I'm watching top defense and I'm watching my bear call spread combo, okay, as long as these add up for net profit, that's what I'm going to manage. Okay. Rick says this defaulting to the AM expiration. That's weird. I mean, I don't know why. It's like we're on 416. There shouldn't be an AM expiration. Make sure you choose all your strikes. You have a 0 DT for today that's not an AM expiration. Tomorrow is an AM expiration, and tomorrow's also a weekly expiration. So unless you're not choosing all strikes or something, just make sure you're looking at the April 16th. That's a 0 DT trade. Okay. So line in the sand is 70.65. So 70.65 is where my risk will kick in. I have my pin price at 70, so I'm going to put a box up here as well. That is from 60 to 70. So my break even on that would be 80. There. So I have my expected move box. I have my defense trade is in yellow. So it kicks in at 60, maxes out when I'm going to take on profit trap. My break even is at 80, and I take on risk above 80. So obviously I'd like to see price, not go above 70.60 today, not go above 70.65 today, and just see if we're going to stay just kind of hanging out while hovering around maybe 7,000. Right? Market just kind of takes a breather. Then we come into OPEX tomorrow, and we'll see what that gives us. I mean, the technical side of me would love to see the market, poke these highs and then pull back aggressively. Look, if we're going to be in a bull market, we probably don't want to see that happen. If we're going to be in a bull market, what you'd like to see is price do something like this and just kind of pause for a couple of days, and then you want to see the market break and go higher. You don't really want to see this reaction. And the reason why I say that is because all it takes is the market to basically get all those trap longs out of trouble. And then if we resume a really aggressive downtrend, even to this level, it's like this is the make or break for the bulls and the bears. I just don't know if the bulls are going to step right back in and thrust this thing higher. Right now, the bulls have taken so much of this momentum out of the bears' hands that the bulls can just maintain this. And we'll see if the earnings over the next 3-4 weeks is enough to drive this market higher. Right? There's no major Fed stuff. Everything in the Middle East seems to be de-escalating. May is going to be a big talking meeting with U.S. and China. So, I mean, positive earnings, positive global flows would probably mean more positive drift. But if the market turns really aggressively and comes all the way back down to like, let's say I'm referencing like SPX, if it pulls back to like 6,600 or 6,500, I think the bears have a fighting chance to take it back, which would be just head spinning volatility. We've taken months to drive this 10% correction, 3 weeks to take it all out. And if we have crazy volatility, it's like that is not what traders want to see. So I'm telling you, like the easier trade of the year is this market just kind of chops around for a day or two, and we see if the bulls can just resume control. Right. But like I said, I'm playing the probability of a pause. That's it. 10 days in a row, 11 days in a row, I'm playing the pause probability. Whether I'm right, we'll find out. But the market is sliding lower, and that's fine. That's why I wasn't calling the low today, just in case it gets a little bit wild. Remember, we still have an 18-19 VIX. So, I mean, if you're looking at what could the market move today, well, if the market spends all day going up in VIX and we go to 19 or 20, the market could still give us a 1+% sell-off. If we're at a 19 VIX, I mean, the market could still move 1.2%. That 1.2% is not going to be to the upside. That 1.2% is probably going to be the downside. So we could be pulling back into this, 69, 70 zone. And I just don't want to be on the wrong side of that trade. So that is why, yes, I did lose and I had to sacrifice a little loss on Tuesday to finally get, the probabilities of, too far, too fast and 10, 11 days in a row, is maybe starting to show the signs of topping a little bit. Okay. And just doing a quick look for today as far as advanced decline, look at our mags. Mags is selling off this morning. That's a big indication with big market cap. Apple is red, Amazon is red, Broadcom is paused, Google is down a little bit, Meta's down a little bit, Microsoft down, Netflix not a Mag 7 anymore, but this one just ripped off those lows at 75, which is good. Nvidia down a little bit, actually gapped lower and is red. Tesla decent red. Okay, so that alone is putting a lot of pressure on the market. Could this come back and be a buy into the close tomorrow? Maybe. But for today, looking at red on mags, that's enough market cap to probably drag the S&P down with it. And we're at 70.14 right now. And this should be looking better. I mean, our $2, $1.70 right now should be looking pretty good for profit. Look at that. So between the combo, I mean, I've got the defense trade. And again, I need to add these up together. So look at the trades here. So I'm up right now about $70. And I'm trying to get a max. My max profit should be about $155 on the day. So if I don't do anything else, 155 is going to be my max on the day. That means I would sacrifice a 15-cent debit on defense, but I get my $1.70 to be a winner. So I lose on defense. I win my daily profit play. I walk away with $1.55 today. Okay. But I'm really kind of loving the sell-off. Yeah, I took those yesterday, Donna. I called the top yesterday, going out to Monday. And again, full disclosure, it's like I'm doing this kind of discretionary, and I'm doing this with a little like Tuesday paper cut in mind. That I was like, look, I know I'm going to get a pause, and so I was going out with the market at highs yesterday around that 70-20 zone. I went out to Monday, and I thought if we have a pause day either Thursday or Friday going into the weekend, I would hope that the market is going to at least give us a pause and not stay above. This is close, right? I mean, 70.85 and 70.95, they are broken wing butterflies. So I'm at least building in a little bit of a profit trap. But if these show profit by, later today or tomorrow, I'll probably just take it off the table because I still think these are close. Defense not posted. Well, it's going to be cheaper now. So defense, top defense. Defense is optional just because the trade's looking good as it is. I don't think we need a ton of defense today, but the market's been doing this all week, so I don't mind having some defense, right? Market pulls back and then spends the rest of the day rallying. If that's the case, I mean, we might be in the same conversation this whole week, which is like, well, market's going to try to finish at the highs today, but the day isn't done. So let's figure it out. If you want the defense, it's going to be cheaper. So the defense trade that I took, coming in Telegram, 4/16 expiration. I bought the 70.60. 70.70 was my pin price. And then I did the 70.90. I did that for 15 cents debit. If you want to tighten it up a little bit, if you tighten this up by one strike, you can take this for 20 to 25 cents. This risks $1,015. If you trade buy the 70.60, sell the 70.70, and buy the 70.85, that is a 20 to 25 cent debit. This risks 520 to 525. So if you want to tighten the risk up on defense, you can change the strike to the 85 versus the 90. So you pay a little bit less, you tighten up the risk, and that's obviously not going to burn as badly if price goes to 70, 90. Nice. Dave said just got filled for 10 cents. Okay, good. That's probably my trade then, right? Yeah, 5 cents debit on that defense. I mean, the fact that price is down to 70.15 is good. So the defense is, again, like kind of rendered useless if price is going to fall. But on a positive note, if we hang out around this like 7,000 handle, or even, I mean, what's going to be interesting is if we crack back below 7,000. Like, what does this look like for the day if we sell off a little bit, just kind of chop around, hang out around 7,000, come into OPEX tomorrow. Is the market going to rally? It's going to fall? I don't know. You know, I don't know. I don't really care, but I'm hoping that obviously if I'm calling the top here, that we get paid for the day. Okay. Somebody's asking about the VOLD, VOLD. That's basically a volume based advanced decline. So like what's going up, what's going down. That's a good thing to use when it comes to spotting some divergence when the market is making higher prices, but the volume in advancing is disagreeing, right? So if you've ever traded divergence before, when price goes higher and momentum goes lower, that divergence is usually a sign of maybe a small correction or pullback or a top. So Vold can work the same way. If you can spot divergences, you want to see either one, if things are in total agreement where you have, everything's up and volume is increasing, like that's a good sign. If volume is, or sorry, stocks are going down and volume is increasing, that's, if they're in agreement. But the tops and bottoms and the reversals are when those things will disagree. So if prices are up, but volume does not agree with that, then we tend to see a little bit more of a like reversal environment. Make sense? It is in Telegram. Yeah, I posted this. So there's two defense trades, one for 15 cents, which is what I took, or if you want to change the strike down to reduce the risk by $500, then the defense can go 70, 60, 70, 70, 70, 85, and that could be like a 20 to 25-cent debit. I know. Yep. Jez Global saying market's up 12 days in a row except for oil. I know. Longest streak since 2020, 2021. I know, which is why I'm taking a stab at shorting the market today. It's just for today. That's really all it is. I thought 10 or 11 days in a row is kind of a lot, and I'm taking my chances. I'm actually, I mean, part of me is kind of happy that the prices that we got today. I wasn't scoffing and annoyed that like we're taking two bear call spreads, and I'm actually getting $2 credit. I got $1.75. But yeah, I mean, offering that like $1.90, $2 right out of the gate, that actually didn't offend me because I felt like with a plus minus 35 that we were getting such terrible premium this entire week, that today actually felt like it was offering a decent premium to sell the calls. So we did, and hopefully it's going to work out nicely for us. Korean, it's in my daily profit play alerts. So if you're a daily profit play member, then you have all the alerts from the trade I took this morning with the bear call spreads to the defense trades. If you're in my public Telegram, that's just getting you into today's session. Okay. Iran ceasefire ends April 22nd, which is going to be next week. Give more time, or will bombing begin? I mean, we'll find out, won't we? That's going to be the wild and crazy part. Is this 2-week ceasefire ends apparently the 22nd. I would think. I mean, honestly, I don't even know what to say about it, other than there's going to be a bunch more noise around it. I truly don't think the market cares that much. At this point, the fact that there was at least a talk, there was at least a ceasefire, the brinksmanship of like, it sounds probably way worse in the headlines than it actually is. Look, the world doesn't want the Strait of Hormuz closed down. It affects the Asian economies way more than it affects the U.S. But if we're trying to play nice everywhere, it has to be something that remains open and has to have. I mean, just remove some of the friction and some of the geopolitical escalations. So, I mean, if we have more like, I don't know, if we remove the ceasefire and all of a sudden there's more bombing, more attacks, I mean, sure, the market's going to hate it a little bit. We're still in an elevated VIX environment. I just think we need to focus on our trades and just grind. I mean, just because we return, I mean, just because the ceasefire means that this is the time for the market to rally, I'm not going to sit around and wait for the next ceasefire to buy the market. I mean, if anything, if we have high volatility, I'm just telling you, based on this structure right here, if this market pulls back, there's still buy opportunities in this area. And this is a lot of volatility. Okay. But if the market pulls back to 6,700, 6,600, I still see that as an opportunity to buy the market. Sorry. So, what's the most challenging environment? If we pull back into here and we don't stop. So, let's say we have an aggressive pullback and the market keeps going and keeps going and keeps going. What was the point of this? The point of this was to get everyone out of trouble from overloading on those shorts or getting stuck in those longs, and all of a sudden everyone is able to I told you that if this happens, this entire market is a de-risk market. Okay? The cycles would be incredibly fast. If you have CTA, I mean, this week, the reason the flows are so aggressive, you had hedge funds re-engaging and you had CTAs re-engaging, getting long, right? I think that's probably going to be the new normal. I don't think the market cares about Iran anymore. I don't think the market cares about any of the noise. This was noise. It clearly showed what the market's capable of doing. I think now if we just hold these levels without too much of a nasty pullback, that the market's going to spend most of its time just trying to grind higher. Okay. Is it going to spend the entire year grinding higher? I have no idea. But if Trump's going to have a chance to win the midterms, he's got a much better chance of doing it for the market at 7,500 than he does with the market 0% for the year. I mean, everyone is saying that he has no chance of winning the midterms. Okay, fine. You can bet against that guy all you want. Nothing's ever stuck to him. Nothing ever goes wrong for him. There's so much blatant corruption going on right now in the government, in insider trading and insider transactions. I'm telling you, if we are at all-time highs, like decent amount, like the market's up, 7, 8, 10% for the year, he might have a fighting chance, despite all the noise and all the craziness. That it's a lot harder to convince, approval ratings when the market's been flat and you have all this crazy stuff going on versus, look, your 401ks are up. We're doing this for you. Blah. I don't know. I mean, all I know is that the market right now cares less about Iran. And it's pretty evident that the market cares less with that type of price action. This was, we didn't know, right? And when it's breaking key technical levels, if you see this black line on the chart, I measured out, this is one really important study, that if the market spends 30 days, okay, 30 calendar days, about 20 to 22 trading days below the 200-day moving average, that usually leads to a decline in the market. The fact that we went about 2 weeks and we are back above that 200-day and above everything, now those moving averages are now showing buy zone, right? Everything's in a buy zone. So it is hard for me to think the market's going to go weeks and weeks and weeks of chop, weeks and weeks of down, 3 weeks of rip, that the market's just going to roll over and be like, okay, that was a good run. Everyone got out of trouble. Now it's time to de-risk and deleverage, right? If you think about it, nobody likes to be short, okay? The wealth effect of this market is too powerful to the downside. If we have a 10, 15, 20% correction coming our way this year, it's going to suck for everybody. And yes, unless you're an insider that is shorting the market, nobody's doing that. I mean, you can have puts, you can have out of the money stuff that pays, but nobody wants to see the market go down. So I think after this type of posturing, the market's probably going to do better, just maybe dancing around the 7,000 handle. Okay, getting all the bears out there to be like, this is it. They just trapped the longs. The longs are out of trouble now. Now they're going to start de-risking again. I'm not listening to that crap. I think this market is so resilient always that you cannot fight this type of flow. And anything in here, in my opinion, is a buy the dip. Okay. Until we take out this low, this market is a buy the dip. So literally, if we have a pullback, I'm probably still going to position. I can still position waterfall strategy 2 out of the way and have defined risk. I still think a lot of my lows are going to be based on a 6,000 handle this year, which maybe won't even be needed. But a lot of my profit that I'm staring at, which is going to be close to 400K this year, if I get all my expirations by May, June, July, August, September that I've stacked in when we've been, selling premium all year because the VIX was at 20 to 30. It's like it was a great selling environment. But I was using these lows. I'm so far out of the money on my trades. Okay. And so where does it get tricky? Well, if it's this type of look, well, yes, that's a very tricky environment to trade, isn't it? Broadening patterns will drive the bulls crazy and the bears crazy, and the bulls crazy and the bears crazy. Last time we did that, closest thing to it would have been about 2015 to 2016. The market was sideways for a peak to trough of about 18 to 20%. Okay. If this is going to be a peak to trough of maybe 10 to 13% ish, that's a challenging market to trade. But I think for the midterms, Donald Trump has a much better chance of surviving and having some control maintained, at least maintaining the Senate or the House, but I'd say Senate probably most likely, if we're sitting at all-time highs. At least having some majority, maybe not full majority, but some majority at all-time highs. Versus if we're still here and still chop suey, I don't know. I don't have a ton of confidence that you're gonna sweep the midterms because the market's not really excited about anything. And this is so much a part of our economy now. We try to say the economy's not the stock market and vice versa, but it's like it is. It very much is. If anybody has a 401k, you're very much tied to the markets and where this thing is at. You do not want to see this thing down 20%. Okay. You will vote based on your pocketbook, whether you like it or not. If we are down 20%, you're not happy. The one thing you can do as a US citizen is vote and be like, I'm not happy. So I'll go the anti-Trump vote. That's what 2020 was. Do you think anyone wanted Joe Biden to be president? It was an anti-Trump vote. And of course, we can argue that it was stolen. It was rigged. Then you're questioning our democracy. Anyway, not here to be political. I'm just saying Donald Trump, from a vantage point of having higher highs and all-time highs in the market, looks a lot better going into midterms, and that is 6 months out. That is a big deal. But the market doesn't care right now. Not yet. What the market cares about right now is this Iran stuff did weigh. The oil shock did weigh. Okay. And it churned to about a 10% correction. Now, the fact the market is up in 3 weeks, got to give the market props for hanging in there. I think now this posturing is, as long as we can hang out here without too much damage around 7,000, most likely this market's going to be a buy the dip and we start stretching to new highs. So just keep an eye on it. All right, Rick, you got it figured out. Good. Yeah. Pentagon briefing earlier, 10,000 troops in Iran. Yeah, fine. I mean, the market reacted so adversely to that when we're going to have boots on the ground. I just don't think it cares. Nobody cares. I mean, if it happens, we have troops there. Okay, fine. But is it to keep the Strait of Hormuz open? I mean, globally, that's better than boots on the ground to do what? Right? So I don't know. Anyway, I'm sick of talking about political stuff and geopolitical stuff. The market is showing us what we need to know. Okay. All I'm doing for today is making a calculated bet that having 10 to 11 days in a row to the upside is due for a pause. If we get that pause today, we're going to get paid. Okay. I accept the risk. I know that if price is going to, get up here and close up here, I have a $1,000 buffer between 60 and 70 to help get me out of some trouble. My goal, of course, is that the market maybe just makes a high for the day, hangs out here, doesn't really do much, and then tomorrow's a brand new day. So we'll see what happens. But if the market rolls back below 7,000, it's still just a pullback. I still think it's a buy the dip. Okay, but a pullback would be nice. Even if, and this is just some simple technical stuff, I don't know when this thing's going to be the official top, but if you drag a fib, okay, if you drag a fib like so, and again, that's assuming that this is the high. If all we did, and just a couple percentages to watch for, if we pull back to the 23 or 30% pullback zone, that's enough to see the market use it as a buying opportunity. In the stock market, usually a 30 to 38% fib is a very common pullback zone. You rarely get the 5.0s and the 618s unless it's a massive swing. But for the most part, when this market wants to posture and stay above all these moving averages, look at how they're stacked up right now. All these moving averages are hanging out between around 6,800 and 6,600. So if we even pull back to those levels, that would be a buying opportunity, in my opinion. And even if you're buying it in here for a stop loss below the 6,300 low, that's fine. you can set your risk up there, and obviously you can stop it a lot faster if you want to, if we fill that gap. But point is, I mean, if we have this remotely accurate for a pause today, um, 68.71, 68.25, I would just say like 6,800. Go back to these lows. What are these lows? About 68.20, 68.50, 6,800. I mean, to me, this is still support. It was previous support. It held, it broke. We got up to it. I mean, once we gapped up here, it's like, I think it's still support. So I just say keep that in mind. Would you close the condor at 70 cents? Well, I'm not in a condor. I'm in a bear call spread combo. So if you're already up 100 some dollars, then I mean, you can close it. I mean, I'm up about 80 bucks right now. Would I close it? I mean, if I want the quick money, yes. Take 80, 90, 100 bucks and close it. Walk away. No risk for the rest of the day. You're done. Okay. I'll probably let it hang out a little bit longer. I think if we're gonna fumble around between the highs of the day around 40, lows of the day around 9, that's a 31-point move, plus or minus 35. So we opened up at 40. 75 was my expected move box. It's like I have all the stuff highlighted, but I don't have any risk to the downside today. All I have is if the market struggles to make new highs and close at the highs. Okay. That's my trouble. If the market is breaching 70.65 or, obviously breaching this yellow zone, that would suck because that's going to be annoying. Like, hey, I just lost by trading to the upside again today. And we'd have a what? A 12th day in a row on the Nasdaq and a 11th out of 12 days or 10 out of 11. I think 11 out of 12 in the S&P. So it'd be, I mean, again, it's like the market can do all sorts of stuff and it always can surprise you, but very rarely. Once we started hitting 10, I was like, yeah, I'm going to get a little bit more aggressive on the tops. Yesterday worked out fine. I ended up grabbing a couple $100 yesterday at the close, and I got very lucky on an extra fill. It was a greedy fill. I did a 69.30 by 70.30 bear call spread, and I got filled and it closed for $7 or $8 profit at the end of the day. But it was like I got lucky on the fill. So the fact that we've had 3 days in a row outside of my expected box and literally closing at the highs every single day. I mean, honestly, for as much as I paid attention to this zero DC stuff the last 3 years, 4 years, I mean, trading this since like summer 2022, I cannot recall that many days in a row with that type of price action. Like breaking the expected move box and closing literally at the highs for the entire day, that rarely happens. But it happened. So I get it. But hopefully today, all we need is one pause. We have a pause for the day. Price doesn't come above 70.65. We're good. So most likely what I'll look at today is between these two positions. If I'm showing, I mean, my max profit on the day is $155. Okay. So realistically, if I'm up 120, 125, and I don't want to worry about the rest of the day for risk, I'll just take the profit, move on. So if I'm up over 120 bucks today, so $1.20 net, I'll probably just take the profit. Get rid of the risk, take it as a win. I'll forfeit the extra 20, 30 bucks on the day. But we're getting closer now. It's up closer to 90 bucks. So let me see. Let me just set a chart alarm at 7,000. This will look pretty good if we're at 7,000. The dreaded curse of almost never. Yeah, but that's why it's defined risk. If I was really crazy, I'd just back the truck up and I'd double down and a martingale, and I'm not that trader. I'd lick my wounds on. And look, I mean, I got burned on Tuesday. And I literally needed. So this market right here at 58. This market right here at 58. I was only down about $400 on the entire day. And if it went down to 55, so we were at 58, right where that little red candle is. That was at 69.58. If we went down to 55 or 50, I would have had 0 losses on the day. I would have walked away with like $400. But instead, it popped up and closed at the high for the rest of the day. My defense didn't work. My defense is up $500 and it turned to negative 200. That's how fast it moves. If you're, just the difference of those strikes. Point is, it's like, yeah, I lost, but it was a couple points off, and a couple points for what I traded made a big difference for the day. But the reality is, I made money yesterday. I made money on Monday, and today we're looking pretty good for more money. So it's like, yeah, I lost on Tuesday. That's it. The rest of it's like 9 out of 10 trades we're winning, and we figure out how to just keep plugging away and making money. Okay. So, yeah. But the market can always do those surprising things, right? They're honestly one of the best sayings ever is John Maynard Keynes, the market can remain irrational longer than you can remain solvent. So that is why I understand that the markets can do things you never expect it to do. Right now we're in an interesting environment where things happen faster and they seem crazier because it's so much noisier, but the markets can do whatever they want. Okay. And if we're all having this conversation 5 years from now and the market's down 50 or 60 or 70%, everyone thinks like it can't possibly go lower. Maybe it does. It can't possibly go higher. Maybe it does. This is why a lot of what I do is just define risk. If I'm wrong, we survive it. We stick to a plan and process, and these trades work out with a mechanical edge in the big picture. We don't lose a lot of trades, right? But when we do, we have to understand like, okay, what happened? Did I do something wrong? Did I do something wrong? No. I followed my plan like I do every single day. And where did I get caught? Well, the market broke through my calculation Monday, and it broke through my calculation Tuesday, and it broke through my calculation Wednesday. That's rare. Okay. But it did happen. So I, tip my cap to the market. I'm annoyed that I lost on Tuesday, but I won Monday, won yesterday, and we're looking pretty good today. If I had those toppy trades that I can make a few more bucks on Monday, great. I'll stack up another, maybe $500, $700, and I'm actually going to be in profit. Let's say that I'm right. Let's say that today we have a win, and then tomorrow's Friday. We figure out how to trade Friday, make another win. This is over in what? So I lost Tuesday. So Wednesday, Thursday, Friday, Monday. In those 4 trades, I'm going to come back and I wipe away the losses, and I'm back in black, and I'm back to fresh highs. That's fine. Just keep trading. Keep trading. Do I keep the defense trades? I'm keeping them. If I'm going to close things down, like right now, I'm up about $100. If I'm gonna keep this trade going, what I'm going to look at is the bear call combo is up $270, but it says 270 because I have 3 contracts here because I overlap the strikes with my broken wing butterfly. So for me, the smart trade is to close out both of these together and just take the net profit. So right now I'm showing negative 143 and then plus 280. So right now I'm showing about $120 profit on the day if I close out everything and I get the fills that I want. Okay. And honestly, the way that the butterfly spread might be a little slippery on the fills, I've got to be careful on closing this thing and not accepting like the market order. It's like I want to set it to make sure like I'm at least protecting, $120 to $125 of my profit today. So you can see like 176 to 280. It's right around $100 in profit. But I know that my max profit on the day is 155. If price stays below 70.65, I've got $155 in the day. Okay. So that's what I'm going to look for is between these two. Is it obviously up like $130 or $140? If so, I'm pretty confident I can close it down. If I sacrifice 5 cents or 10 cents, I still keep most of the profit. But I'll need some time in that trade. Okay. So we'll see how it plays out. But right now I'm sitting about $100. And again, if you like $100 and you want to take it in the first, 50 minutes of trading today, take your profit. Take $100 and enjoy your day. Go find something else to do. Sit and watch the markets all day. All right. Double up trades. It's been a couple weeks. I haven't taken a double up in a little bit. We had a nice winner the last trade we took. Let me find the spreadsheet here. So last double up was We had, oh yeah, I closed that one for a winner. That was 210 credit. March 31st. So it's been a couple weeks. But what I would say, if you're in my double ups alerts, watch the core strategy video that I have and you see like what I do. I mean, if you want to look at, so here's what I would do on, here's a good way to look at double ups. So let me go to real time gamma. It's Thursday, so I'm looking like, Friday DTE. So a one DTE for Mag 7 stuff, SPY, Qs, XSP. So let's have a look. Okay, so here is the SPX 5-minute chart. So the nice part, just kind of encouraging me to hang in there for the day, is look at where most of the gammas collected and gathered. Most of the gammas here between below 70.40, which is where we open the day, and 70.10, somewhere in here, right? So the market just kind of chops around for the day. Our 70.60 is pretty safe. 70.65 is pretty safe, right? Could it get there today? Sure. Is it going to get there today? I don't know. I hope not. Obviously, I don't want it to get there today. But the market just kind of hangs out here for a quiet day, then it is what it is. We take a winner. Now, let me go to tomorrow's expiration. I'm going to change this to, that's for 0 DT. I'm going to go short term for tomorrow. And we'll take a look and see where all the gammas clustered. So I have a 70.50 strike for tomorrow, and I have a 7,000 strike for tomorrow. Those are the big clusters of flows. Let's go XSP. It's going to be similar, probably like 700 XSP and 705 XSP. By the way, what's our engineered option trade for this week? We got filled this week on engineered options. What? Where is my... Hang on. We got filled on a participation trade. What the heck? XSP. Yeah, April 20th. 50 cents. Where'd that trade go? I am so confused. This is the trade that filled on the 13th. 686 by 685. Why is it not in my platform? What the F, dude? Well, that's not what I wanted. So that closed for 18 cents. I don't know how that happened. That was either a user error, which I'm assuming it is, but this should be a full profit. I mean, we're at 701. We need price to stay basically 15 points higher. I mean, it's already 15 points higher. We needed to not just lose its butt for the next couple of days. Anyway, the 686 is looking good. Somehow this closed. I don't know how the hell that happened. But anyway, hang in there for that engineered options. Go for that full 100% winner on Monday. That should not have closed out. I'm not sure what I did. Anyway, I'm off topic. So XSP, where are our levels? For tomorrow, for Monday, this is what kind of is just, it seems to be really sticky around the 7,000 handle. Okay, let's take a look at mags. Interesting, right? So we have this, current level at 65. If mags, this would be a pretty interesting pullback for the market. If mags goes down to find, $62, if we drop to $62 on mags, the market's going to get dragged lower. Now, that's not the end all be all. Obviously, that doesn't necessarily mean that it's going to find it, but let's take a look and see what everything else looks like inside of Mag 7. So let's go Apple. We're having a sell-off today. Okay, we have a positive gamma to pivot around 257. Okay, so I'm curious, if we sell off today and we head back up into Friday, that maybe a butterfly spread of some sort in here can get us paid. Okay, I'll assess this stuff at the end of the day. Let's go Amazon, which has already had a huge rip, by the way. Amazon had this incredible recovery the last couple of weeks. Let me go like 1 hour chart. Look at this thing. Since the end of March, Amazon has ripped from $200 to $250. That's pretty incredible. Now we're hanging out. I mean, sticky level around 250. So if we stabilize, 248, 248.50 to 250, I mean, butterfly spread looks pretty good to see if we get a bounce going into tomorrow. Okay. What else? Apple, Amazon, Google. Google. Now, this one looks pretty interesting. Google has a pretty big level. This is way up here, by the way. I think I'm going to take this trade for double ups. Go into Friday, 345 strike. Let's see if we can get a couple dollars out of that. Let's see what the strikes look like for Friday. Okay, I'm going to go into Google. Google. 17th expiration. We're trading at about 336 right now. Oh, man, that's a pretty big move. Market's expecting $3.80. My gamma level's at 345. That seems high. That's going to be dirt cheap, by the way. So if I did a 345 butterfly, this should be really cheap. Let me see. 345. Let's see if we can go 5 wide and maybe make this like really profitable. Okay, so for 65 cents, I can make up to $500. That's not a bad trade. If we just have a rally into tomorrow, this is all it would need. If we come back up to take out, 340-ish, 340 on its way to 345 going into tomorrow's expiration. If we're up on Google tomorrow, that's a really cheap trade. Now, if I lose 65 cents, okay, fine. I really don't care. But if we have this thing able to pay us, up to $400, $500, I think that's a pretty good looking trade. I'm going to take this trade for, see if I get filled for 60 cents. I could space this out a little bit differently. I could still go like 5 wide this way. Now it's $1. So I'm risking $1 to make 4. I make 5, so I net 4. I'm going to go a little bit cheaper, take my chances on this thing getting into that pin price. Let's find out. 65-cent debit, see when we get filled. I'm willing to pay up to 70 cents for it. That's my max risk on it. So 65 not filling, 66 mid price. Got filled at 66 cents. So double ups. You got what you wanted. Here's a new trade. 148. So Google. Today's the 16th. So 420 expiration. Buying the 340. Selling the 345. And buying the 350. For a 66 cents debit. Okay. So my goal on this one is if I'm paying 66 cents, I'm going to try to get a full double out of it. We can make up to $500, which gives us like $430 in net profit. I'm going to set a profit target here. There is my double ups trade. Okay. And I'm going to set a take profit at, so if we got filled for 66 cents, a true 100% would be 132. I think we can do a little bit better than that going into a 0-day environment, especially. Let's try to go. I mean, if I want to set it and forget it, 132 is great, but I'm going to try to go after, let's go like a 200% winner. So $1.98. I'm going to set the take profit at $1.98. Okay, so this is going out for members in double ups. Here, so double ups. So the 340. And what I'm hoping for is as I go through the other ones, the other Mag 7 stocks, is that we have others that are showing like maybe one's down and one's up. And that way I can kind of space this risk out and just have one nice winner. That's all I need. Max risk, and then setting a $1.98 credit for a 200% winner. Okay, so let's keep going. So that's Google with a nice little gamma level at 345. Let's go NVIDIA. Actually, let's go M. So Meta. Meta, little dicey. I mean, we can go down to 660. We can go up to 680. If it's cheap enough, I don't mind. It's just hard to pick a direction. Like this one looks like the bigger one of the two. Let me see if it's cheap enough to take the trade on Meta. I just don't want to go the same direction on all of them, right? So I might hold off on Meta, but let me see what it looks like for tomorrow. 670, 680 be the pin price. So if I pin 680, what's 5 wide here? I mean, that's so cheap. All right, I might take Meta both ways. I'm going to take Meta up to 680 and down to 660 and pay like nothing for both of them. Right? This is 40 cents debit. Like I'll take that trade and I'll put a spread down here as well and see if I get one to pay me. Okay, let me go 40 cents debit on Meta. 41. I mean, mid price shows 42. These are really cheap. Hopefully it's less than 45. Okay. If it's less than 50 cents or at 50 cents, then I'll take 2 trades. All right, 47 cents. Now I'm going to see what the other one looks like. I've seen a lot of people asking what's the software. It's a Dynamic Trend. If you email me, I've been an affiliate with them for like 6 years now. They have built me my own version of this. They built me an exclusive like 0DT service. So I've got a pretty good discount. This usually runs like $3,600 a year, and that's what I pay. But they built me a nice 0DT version of this, so uh, I can see like the gamma squeeze on these short-term options. You can go to any ticker. And so this is what I'm doing. I'm using my short-term gamma, and this is, all my stocks. So I trade primarily like SPX and XSP every single day, QQQ, SPY, but I love the Mag 7 stuff because it's very liquid. Now let's see what the 660 handle looks like for a butterfly. This will be 5 wide and 5 wide. Hopefully it's just as cheap. Same price. Yeah, 46, 47 cents. Let's go 47 cents. Okay. So I've got 2 butterfly spreads in, one of them down to 660, one of them to 680. As long as I can get either one of them to get me a profit target of, essentially I need one of them to pay me like $1.50. I can make up to $5 on the trade. So if I set a take profit at, $1.47, or I should say a take profit like $1.50 credit, that covers the risk on one, wins the other, and I'm net out like 50 to 50 cents to $1. So I'm thinking, let me see if I can set like a $2 take credit or take profit. Meta. So the put side, 1, 2, 3. Double up. And double up. All right. So I'm going to go ahead and set a take profit at $1.50 is fine, because if I look at it from the price action, if I pull $1.50, so 47 cents times 2, that's a 100% winner. Okay. Plus 47, that's a 200% winner. Yeah, I think $1.41 is probably smart. I'd like to set it at $2 and just walk away from it, but $1.50 is probably good. All right, I'll set this at $1.50. That makes me some money. So close it down, $1.50. Close it down, $1.50. All right, so that way if one of them wins, I would have $1.50 minus 47 minus the 47. I'd still be up $50 and I'd lose one, win one. I'd still walk away profitable. I can get greedier and try to put this at like $2 and I make $100 and that's fine. But I would have to be later in the day tomorrow with expiration, and we'd have to be closer to my 680 or my 660 strikes. So I'm just going to go after a pretty, I'd say low hanging fruit, because a double up that offers, $5 max profit, which would be a net 553. I'm sorry, 443 over 47. I mean, this trade offers a 9.5 to 1. So if I'm asking for it to give me a 200% winner, that's pretty reasonable. It offers 9.5. I'm asking for 2, right? So see if we just make a few bucks. All right. So I have 2 of them there. So that's a 675, 675, 680, and 685. That was a 47. Yep, both of them 47 cents debit. And then the 665. And the 655. Okay, so Meta has that trade. Microsoft. So Microsoft was already hanging out around that 420 handle. I think because we started there today, I'm going to kind of kick this one out. We started at 420. It doesn't look like it's an outlier gamma. I'll pass on this one. Let's go NVIDIA. NVIDIA's got a big sticky one right at, oh my God, this thing is super sticky at $200. Let's see if we can get something out of 200 today. Let's go NVIDIA. This one looks pretty good. So what you're seeing right now is literally what I do for double ups. So yes, I'm sorry, it's been a couple of weeks since I've taken a trade, but this is my routine. I put a core strategy video together inside your classroom. This is what you see me walk through. I do that video. It's like 20 minutes, and you actually see me do this exact step-by-step process, and I take a trade on XSP. We close that thing out for like a 60 to 80% winner that same day. So this is what I do. All right, 200 strike. This one's going to be a bit more expensive because we're closer to the money, but can it stick here? So I like the 200 strike. $1.60 to make 5 is a little bit more expensive than I want it to be. It's cheaper to do it this way, paying 42 cents, but now I only make, $2 max. So 250, I'm risking 40 to make 250, but I've got to be spot on. I'd like this to just have a little bit more wiggle room to get to 200. So fudge. I'm curious if it was down here to like 196. Let me see if this will fill. Let's try something here. Let's try a 50-cent debit. Let's go 5 wide for 50 cents and see if it fills. It might not fill, and that's fine. Trade expires tomorrow, so if it doesn't fill, it's no skin off my back, right? So I'm going to take this down to a 50-cent debit. That way, if price falls a little bit, but it finds a way to get back to 200, I mean, that's a really big strike for tomorrow. So if we hang out around here, this might get a little bit cheaper. If it fills for 50 cents and I can make up to, $5 on it, that's a great trade. I just don't want to pay $1, $1.50, $1.60. That just cuts into my profit potential. Oh shit. Yeah, you're right. Is that why I'm getting those cheap fills? Am I doing 420s on those? Oh my God. So stupid. I did 420s on Mondays. I was wondering. Yep. You're right. I did the 420 trades. Crap. Well, that's going to change the way I manage them. So let me see. I'll keep an eye on them I'll watch them for tomorrow. The point is, if they're in profit tomorrow, I'll probably just take the profit. The goal was so this is based on a 3 to 4 day expirations. So this is accumulating, not just today's flow, but tomorrow's expiration and Monday, since it is Meta, or since these are Mag 7s and they have Monday, Wednesday, Friday expirations. So this is still an aggregate of, tomorrow's expiration and these gammas, as well as the weekend, but obviously I'd much rather get out of the trades tomorrow if I can. So what I will do is, yeah, let me look at NVIDIA for tomorrow. Maybe I can make it a little bit cheaper. But for the Google Meta combo, if I'm seeing some net profit across the board, I'll probably still take the profit tomorrow. All right, let's go back to NVIDIA for the 17th. So let's look at tomorrow at the 200 strike. Okay, so that butterfly is even more expensive. I will, you know what? I'll still take the same trade for, let's see, for Monday, 200. Let's see. Let's see what it does. Because if it doesn't fill, it's not a big deal. But if I go 200 by 205 by 195, and this can trade for 50 cents debit, I'll still take the trade. Okay, so this way price has to come down for me to get it filled. And if we just linger around $200 by Friday, Friday afternoon or even Monday at all, we might have a chance. But if it's going to hover around like $1.50 debit, it'll never fill, and there's no trade. All right. Netflix, anything here? Netflix has earnings tonight after market, so this one's probably not one that I want to step into. I do think a simple debit spread though, like there's a pretty good gamma up here towards the 112 handle. One really easy trade for probably today would be either one, we do a butterfly spread here, but because it's earnings, I think if we just have to choose directionally long or short, I think Netflix probably has a better chance of going up tomorrow. So let's see if it's cheap enough to take a trade on Netflix and go after that 112 gamma for tomorrow. They have earnings after market tonight. If they beat earnings, I'm looking at a gamma around 112. If I can do a debit spread right now, the 108 by 109 cost me $45. I can make $55. That's over 100%. I'll take a stab at it. So if we go up on earnings, close it out tomorrow for profit. If I want to go this way, 88 cents to make $2, there's a fighting chance there. If you want to try to make, $100 on this one. So this one it's actually cheaper to go 88 cents than it is to go 47 with two contracts, right? But what do you need price to do? My line in the sand here is if price gets above 109, I make $53. If price gets above 110, right, I'm paying a little bit less. So I'm just going to take the cheap trade, just go 45 cents and see if price goes up today after market. As long as we're under 50 cents, I'll take the trade. 46 cents. That's a double up trade. I'm just taking a quick earnings trade. Okay, double up. That's a 417 expiration. And I'm buying the 108. Selling the 109. Got filled for 46 cents debit. Looking for, 90 cents credit or higher to protect. Netflix earnings after market. And a gamma level at 112. Hopefully pushing prices up. Okay. So that could be pretty good coming into earnings. Netflix, let's see what's next. We did Amazon already. What am I missing? Tesla? Tesla, not really big enough on the contract size. I'm going to hold off on Tesla. I think that's it. I did Google. I did Meta. I'm in Netflix. We looked at Apple, Amazon. We could do Broadcom. Yeah, that gamma is not. I mean, see the current net's only at 262. I'd like to see that in the thousands, so I'm going to hold off on that one. So, all right, we got some action. Meta, Google, Netflix. Yep, and we just ran through that. So, also, if I want to take a look at the SPY, I mean, the big strike in the SPY is 700. That goes into Friday and Monday. I mean, we've already hit it. So it's hard to say, like, I want to trade to this. It's like, I don't know if we're going to stick here. But look at the put option volume sentiment. So this is call and puts at 40 and 37. We're probably going to hover and hang at like 700 today. That does make me want to look at a trade though. For today, I can go SPY 0 DT. If I pin 700 today, maybe an iron fly. What's this going to cost me? So if we hang out within $2 of this, that'd be about a 20-point move either direction. So if we're, lower than 702, higher than 698, there's some profit. We obviously want to try to pin this thing as accurately as we can. That would be, so that's 5 up. So that's 5 up, 5 down, 264 credit, but I make a little bit less profit. And we got to hang out kind of right at like 699.50. That's probably the spot. If I went a little bit wider, you're just not going to get more premium for it. So even if I went 10 wide on an iron fly, the market's only going to give me about $2.30 credit. That's way too much risk. So I would tighten this up to maybe like $4. That way it's about a 1-to-1. Do I love that trade for the day? Not really. Not really. So, because if price slips, $2 one way or the other, you're going to lose. So I'll probably pass on that. Anyway, we're hanging out around 700 today. Let's go SPX. We need price to stay below 70.65. Okay. So the gamma profile's changed a little bit. We're at 70.25 right now, 70.23. High of the day is around 70.40. Gamma starting to sprinkle in around 70.50 and 60. But there's still, the biggest gamma of the day is at 7,000. So we could still find it. I would say this is 1, this is 2, this is 3. The hard part is what direction are we going, right? Look at the call and put option volume sentiment. It's equal. I would think the market's going to pretty much stay inside of this range for the day and not necessarily go any one direction. If it does go directionally, I think it's going to come back and maybe, hang out around like 70-20, 70-30. So just what I'm observing. That's all. Okay. All right. So anyway, I'm seeing some questions that are popping up here. Let's see. I'm getting some comments here. So Goldman Sachs saying the market rally is the narrowest. Basically, lots of magless. Yeah, but you can't have all-time highs without mags. That's the thing I said this whole year. This dispersion trade, you can't have the markets going to all-time highs without tech or mags being a part of it. So this rally could be like a pump into mags and then, possibly a dump. But also the earnings came down quite a bit. I mean, the compression of 25 times earnings S&P. I mean, the Mag 7 stuff came down from like 30s, right? They were calling it the Lag 7 for crying out loud. So, I think there's interest to at least put money back into them, at least in the near term. They were pretty beat up sectors this year. Energy was the one sector leading at like 30% year to date. It was up 40% at one point. But, tech was down. A lot of other sectors were underperforming. So I think at least putting a short-term boost back into Mag 7 is enough to maybe take some profit off the table and finance stuff later, like an Anthropic IPO or a SpaceX IPO and other stuff that the market's interested in. But I just don't think the market can rally all by itself. The energy sector is like 3% of the S&P. So, even having energy up 100% is not going to bring the market to all-time highs. Even having RSP, it's not enough to go to all-time highs and keep pumping without having Mag 7 be a part of it. Okay. All right. What else? Trying to think. So I was going to type this out if interested, if you're checking this out. So if you're interested in, this software, it's called Dynamic Trends. So it is real-time gamma. So I do, 0 to 7 DTE as my focus. I have an exclusive 0 DT package for $945 per year versus $3,600. So for every client out there that does it, on their website, that's $3,600 a year, or like it's basically $300 a month. So Anyway, that's one way. If you like the Gamma stuff, I also am affiliate with Tanuki Trade, which I've talked about this before. People email me all the time for this stuff, and I just send them the link for both because I don't care. I'm just trying to help. If you like this stuff, if you trade regularly and you want to have that visual roadmap, I use these every day. This has a Trading View plugin indicator, which is really helpful. It updates 5 times per day, or 5 times per day. They also have a real time Gamma app, which is a website, and you can go basically from 0 to 30 DTE on short, medium, and long-term Gamma. And what's squeezing? They have filters, and you can do some really nice option screeners and scanners. So either way, I mean, if you're wanting a roadmap to see like where the puck is going, so to speak, this is what I use all the time. This is one of the primary reasons and ways that I feel somewhat confident trading 0 DT. Yes, I can just use an option chain. I can be a savant like Tom Sosnoff and never look at a chart and trade just the options chain and just go like, look, I'm just going to go delta neutral and trade 10, 15 delta every single day. That's fine. I came from the background of looking at technicals and purely trading like technicals and forex and technicals and futures and looking at inefficiencies and pockets and things like that. So for me to not look at a chart just makes me feel like I'm trading blind. So this has helped me a lot, kind of put a visual roadmap to what I'm doing. And, that way we can kind of see like if the market's given us some really clear outliers for the day of like, this is the sense of where the market's going. These are the flows for the day. And again, it's very, very real time. And that helps because this can change. Like 0 DT changes very quickly. It's insanely sensitive. But when the market sets up like pre-market, that's one thing I like about dynamic trend is there's a pre-market and there's a real time. So a lot of times these big levels that stand out, like see how the 7,000 is a pre-market level, it wouldn't surprise me if the market finds it, right? Even though real time, it's like, well, that 7050 is getting a little bit larger. Well, between 7,000 and 7050, we're probably going to find one of them today, if not both, right? But anyway, it helps. So if you're interested, then hit me up. You can send me an email, chrispulverpub@gmail.com. Okay. All right. And if you're interested in any services, daily profit play, waterfall income, newsbreakers, double ups, pinch point. It's a volatility scanner that gives me, I mean, we've got like 11 trades pending this week. Engineered options. We've been winning about 92% of our group trades. Crash insurance. We were long the VIX. I'm probably going to lose on that trade, which is fine. It's going to be like a $350 loss. But if the VIX went up to a 40 or 50 or 60, we had this crazy volatility event in 2026, that $350 risk would have paid us probably $3,000 to $4,000. So that's the type of trades I take in crash insurance. I thought we had a pretty good trade to be synthetically long the VIX. It expires tomorrow, so it's most likely going to be a loss, which is fine. It's annoying, but it's fine. And like I said, if we lose on crash insurance, you shouldn't be that mad about it. And the reason why is because we're generally doing very well elsewhere in the portfolio. Like the fact that I came back from, I was up like 100 grand in January. I was up like 7% for my fund, and then I was down 3 or 4% in February. March was a break even. April, I'm back up and I'm at all time highs again for the year. So I mean, collectively, I don't mind losing on hedges because they're literally like, this is the keyword: insurance. I don't want to constantly hedge my portfolio, but I have to have something in the background that if I need like an outlier event protection or a black swan event protection, that something can help offset some of the trouble. So it's a great way just to learn how to do some basic portfolio management as well as protection. Project Options Edge, it's how I manage a lot of my client accounts. So we sell a lot of premium. We repair trades if we need to. We don't lose a lot. Win rates like 97%. It's if you want to kind of progress your way through my catalog or progress your way through my services, if you've got the type of buying power that we can sell naked options, like sell a naked put, do a cash secured put, do a ratio spread. Sometimes that requires $3, $4, $5,000 in margin to do that. So traders that have slightly larger accounts will probably benefit a lot more from Project Options Edge because we do a lot of premium selling. Okay. If you want everything that I do, I've got a lot of Diamond Club members as well. You can always inquire about that too. I do have some free education out there. So if you would like this One Trade Mastery. I share this with anybody that's interested in learning how to trade options. It's basically just breaking down, look, you want to be directionally bullish, directionally bearish. Here's a couple ways to look at it. Get your beak wet, kind of to tap into the knowledge of like options doesn't seem that crazy, doesn't seem that complicated. It's not. It's not. It sounds insane, but it's really practical, which is why I built a course called Practical Options. And this One Trade Mastery was like a front end thing that I did, a year ago. So this is free if you want it. I'm happy to post it in Zoom. Expected move box. This indicator is what I use every single day for my daily profit plan. I built this. It's $20. If you want it, send me an email. I'll give you the link. Okay. So at any time, if you need this stuff, if you want One Trade Mastery, it's a free session, 70 minutes. Check it out. Enjoy it. Okay. Hit me up. Email me. Expected move box. If you want the indicator, email me. It's $20. Practical Options, quick guide, $27. You want to upgrade to the full course, $497. The full course I also give away as a bonus if you are a lifetime member of any of these services. So this, which I charge $500 for a la carte, if you'd like a full service of mine, then I'll give it to you for free. Including it, I should say. All right. Yeah. So yeah, that's the trading view. That's a trading view limitation, Matt. So Matt's asking about the Tanuki 5 times a day trade. That's a trading view plugin. If you look at their real time, this is real time. So this is what Tanuki trade looks like in real time. So you can watch this all day. The difference is, this visually, to me, looks a little bit different than this. I personally, and part of it's because I've used the software for like 6 years. I like the fact that I have a price chart overlaid with my gamma levels, but I can still see like my key strikes for the day as well. But this is real time. So their web app, they built this in real time, so you can still have the real time gamma. But the TradeView one is limited to 5 times a day. That's not a Tanuki trade limitation. That is a TradeView limitation. Okay. All right. One more thing. Deanna, are we ready to rock and roll with a stream? I think we got a waterfall income stream. I just want to do a quick intro on that waterfall income. So here's the deal. All right, cool. Let's get that out. Don't take the screen yet. Just give me like 2 or 3 more minutes. Let me go waterfall income here. So waterfall income is probably, it is one of my favorite strategies, especially for the general index. It's essentially like a weekly swing trade that I stack up trades. So here's a good way to think about the visuals on it. Let me just open up a brand new workspace and I'll show you. Let me go open new workspace here. So create new layout. Let's go waterfall example. Okay. And I'll pull let's go weekly chart. Okay. And let's look at, this is a good way to think about it. So, okay, I have 2 core strategies. All right. And one of the strategies that I focused on a lot the last few years is my strategy 2. And I said this year for all of my traders, I said this late last year as well, do I think we're due for a correction coming into 2026? Probably. I thought the tail risk was somewhere between 10, 15, 20% to the downside, and the market's going to find some key resistance, here at 6150 that becomes support, maybe 6,000 round number. So I was prepared for this pullback. Now, my point is, if every single week with waterfall income, one of my core strategies is this: if every single week that you start trading, the market starts here, we're going about 10% lower to put in our trade. The next week, 10% lower to put in our trade. The next week, 10% lower to put in our trade. The next week, 10% lower to put in our trade. Now, if I say that, if every week I essentially give myself a 10% buffer, how many times does the market come and threaten those levels? If I'm 10% lower, 10% lower, 10% lower, 10% lower, 10% lower, 10% lower, how many times does the market come and threaten that? Not very often, right? So even this entire drawdown was a 10% buffer. So if I'm 10% lower, 10% lower, 10% lower, 10%, none of those trades were at risk. And it's not only that, but it's price and time and volatility. All right. So even through this, we took 1 loss. Even through this, we took 0 losses. Through this, 0 losses. Through this, 0 losses. Through this, 0 losses. Through this, okay, I took 2 losses in 2022 in a 10-month bear market. And I ended up hitting a lot of my profit traps with my strategy too. 2 losses. The rest of my weeks and months were positive. Okay. Zero losses, zero losses, zero losses. One loss during Liberation Day, and that was because of trades we took in November, not because of February, March, April. All the trades we took in February, in March, in April, participating during Liberation Day drama, we made money for the entire year. Okay. So the strategy is awesome. And we do this stuff every single week. It's one of my favorite strategies. It's one of my favorite services. It's also very easy to run. There's a core strategy video inside of it. So when you become a member, watch that core strategy video. There's core strategy 1, core strategy 2. Get you right up to speed. We trade this thing every Monday live together at 11:30 a.m. Eastern time. Okay. So that being said, nice little intro. A lot of ways to trade the market. This is one of my favorite kind of passive index swing trades. That is one of my like forever strategies. If I'm going to do something for myself, for my clients, for all these years to come, this is one of my favorite strategies to survive the markets and, avoid a lot of the drama, avoid a lot of the noise, and just trade the market that is and do it all define risk. Okay. Yeah, we're doing this every week. So every week on Mondays at 11:30 we're live. So all right, Deanna, go ahead and grab the screen and let's run a little stream. If anybody wants to jump into waterfall income, I would encourage you to get the service. We trade together live on Mondays and check out that core strategy video when you get access to the classroom. I would say do that first thing. It's like a 25-minute video. All right, check this out. Thanks.